The full budget 2024 is just around the corner, and with Nirmala Sitharaman, the finance minister, back in charge, it is obvious individuals, industries as well as market participants have started jotting down their expectations from the finance minister. I am Stacy Pereira, and in this special segment, we dive deep into what we can expect from budget 2024. And today in particular, we are going to be talking about what the Indian equity market wants and expects from the upcoming budget. Joining me to give us a sense of what exactly we could expect is our special projects editor, Santosh Nair. Welcome, Santosh, to the show.
Thank you, Stacy. Pleasure to be here with you.
Also, to all our viewers, don't forget to like, share and subscribe to Moneycontrol for more such content. Well, Santosh, let's dive straight into it and address that one concern that has been bothering most market participants. I'm talking about capital gains tax. Now, capital gains tax refers to the profit that is earned from any sale of capital assets such as real estate, stocks, mutual funds or any other investments that you would make. Now, in India, we categorize these into short-term as well as long-term gains, and each of these attract different tax rates. Firstly, let's just break it down for our viewers and exactly understand what is this definition of LTCG or long-term capital gains, and what really is that bone of contention, and why has the industry been demanding some kind of clarity on this specific tax?
Well, Stacy, first up, the mere mention of the word taxes seems to have market people in a kind of dizzy, and this is the kind of typical reaction you always come across just before the budget. So when we're talking about long-term capital gains and short-term capital gains here, so it is, as Stacy also mentioned here, the tax rates are different across different asset classes, and also they depend on the period for which you hold on to them. So now let's take, for instance, equity. Now, if you are holding equity assets for, let's say, 1 year or less and selling them during that period, it means that you will have to pay a 15% tax, which is your short-term capital gains tax, because you're holding it for 1 year or less. But at the same time, were you to hold it for more than 1 year, if you were to sell it after 1 year, you would be paying a reduced rate of tax, which is 10%, which is the long-term capital gains tax. So this is the difference as far as the equity asset goes. Again, the rate is different for something like, say, unlisted shares, and it's also different for real estate. So in the case of unlisted shares, you would be paying about 20% tax if you were to sell it after 1 year. That's the long-term capital gains tax. Right? Same goes for real estate as well. But if you were to sell it, if you were to hold it for less than 1 year and sell out, then you would attract a short-term capital gains tax, which is the same as the income tax rate slab that you follow.
Well, quite interesting, Santo, but last budget, the government did remove that benefit of indexation when it came to long-term capital gains, and especially for non-equity mutual funds. Could you just tell us more about what happened there and where does that stand at currently?
So, in the case of debt funds of mutual funds, debt schemes of mutual funds, previously, if you were holding it for 36 months, you're selling after 3 years, you would be paying just about 10% long-term capital gains tax, and also you would have the indexation benefit. Now, that was changed last year. So, this rule was applicable till 31st of March 2023. From 1st April, that changed, which meant that irrespective of the period which you hold it for, you would now be subject to short-term capital gains tax on your debt holdings in mutual fund, and also the indexation benefit was removed. So the short-term tax rate here is at the applicable income tax rate that you follow.
Right, so that was what the benefit that was taken out. And for the benefit of our viewers, what we really mean by indexation, it is that process where the purchase cost of your mutual fund unit or your mutual fund is basically adjusted on the basis of inflation. And this helps because that capital gains or the taxes that would then be levied on it would then get reduced. So at present, if you have to go by what Santo also has just told us, your short-term capital gains currently is levied at 15%, as well as this is for equity, and at about 10% when it comes to long-term capital gains. and this for the holding period of 1 year. This is where we sum up of what we're really talking about when it comes to long-term as well as short-term capital gains. But one of the demand has also been that this time period rather be extended when it comes to long-term capital gains. Maybe 1 year, or like it was 36 months before, whether that should be really increased, or that would be better than having actually to increase the rate. At least that is one of the demands that we're hearing from the people that we're speaking on the street. Also the fact that if there is a uniformity in the kind of holding across all asset classes, that is also something that has been an ask. What really would change, and how will the street really react to it if we get to hear something on these lines?
Well, both options. One is that the increase, that's the increase in long-term capital gains, or the alternative, that is to increase the period of holding and keep the tax rate same. In the short term, clearly it would come as a sentiment negative, because at this point the market clearly does not want any changes to that. But there is a fear. It's not something that the market is expecting. That rather, I would say it's something that the market is dreading, that long-term and capital gains tax would be brought at the same level.
Yeah.
But the bigger fear is that probably if there is uniformity across all asset classes, and then the entire tax rate itself moves up, starting from 20% onwards. So that is the bigger fear in the market at this point in time. But there's also a section of the market which feels that the government also is looking to divest its assets. So it's quite possible that the government may not want to upset the sentiment at this point, and probably leave the tax rates, long-term capital gains and short-term capital gains
rates
unchanged in this budget at least. So there is definitely a fear that there could be some tinkering in the tax rate, but at the same time there's also this expectation that because the government is also looking to sell assets through divestment in PSU companies, they might not want to upset sentiment.
Right. Well, another ask also has been to increase security transaction tax, or something that you would hear as STT, and this on high frequency traders. Now, why exactly is this demand that has come forward? And also, STT, for our viewers' benefit, it is the sale. It applies to every sale and purchase of equities that are listed on any exchange. So, Santo, what exactly are we talking about here, and who really does this go on to impact? Does a retail trader also pay something like this, and how does it work differently for these high frequency traders that people are demanding that they be taxed higher?
Well, okay. So right now the STT is standard for all categories of players, whether you are a retail investor, retail trader, or a high frequency trader, or a high net worth trader. The rates are similar. Now there is this growing feeling that because of high frequency trading firms, retail traders are losing a lot of money. That's because high frequency trading firms use sophisticated technologies, very high-end software, hardware, which puts them at a very big advantage compared to the retail traders. And there is a feeling among the regulators and policy makers also that speculation in futures and options has grown out of proportion completely, and there are too many retail players in the market, which is not a good thing for the longer term health of the capital markets. So one way probably to curb this kind of participation would be to tax HFTs at a higher rate. Now the proposal to levy a higher tax rate on HFTs, that's a higher STT rate on HFTs, has also come from the mutual fund industry mainly, because they feel that because HFTs are quite, they trade very, very rapidly, they use high-end software, because of which the mutual funds also are put at a slight disadvantage, which seems to be the reason for them asking for this differential rate of STT for HFTs compared to the rest of the market. But I don't think that's a very practical ask.
Right. So we might not see too much of that change. Right now the STT rate for selling options is somewhere at 0.017% currently, while for futures it is at 0.01%. So that would be quite interesting to see, because it would have both those benefits as well as the ones that are missing out. Your retail investors might, then say, okay, I might still have a chance because you're, taxing the high frequency traders a little more. But another one of those speculations.
Just one thing, if I may add here, Stacy. See, it's again in the F&O market, the volumes it's a demand-supply game, right? More retail investors come in, they want to trade. And because there are HFTs which are active, there's someone to take the other side of the trade, okay? So, if you really want to curb speculation, you'll have to do it at both ends probably. You just can't target one segment, because if you're going to reduce the participation of HFTs and not doing anything to reduce the participation by retail traders, you'll have more retail traders coming in. But even within retail traders, there will again be there will be the HNIs, there will be the weak hands. So someone will continue to win at the expense of others. So that is not really going to change, because that's the very nature of the market.
In fact, another much speculated that you're getting to hear, at least another one of the speculations, is that the government may actually just reclassify this whole F&O transactions from business income into speculative income. And this is something that has been doing the rounds of newspapers as well recently, saying that they could then altogether rather impose that higher tax on F&O, as well as your F&O income then not being considered as a business income and then being looked at as a speculative income. How much of that will make a difference, and what does that really bring on the table?
Well, Stacy, on a lighter note, if you go by the SEBI stats, that 8 out of 10 F&O traders, retail traders, don't really make money. So I don't think they should really make that big a difference. The reclassification makes a difference if you're making a lot of profit. But that said, I don't think so. Again, this makes much of a sense, because this kind of trying to have a different treatment on this or change it at this point in time, because the large HNIs who are playing, who are actively trading in F&O, they are the largest segment at this point, and for them it needs to rightly be treated as business income itself. Because the other concern for the government would be that if you were to allow setting off, right, on one trade and the other, there is a possibility that their traders could try to come up with workarounds again to keep their tax level at the same thing. So yes, there's all kind of speculation doing the round at this point.
One more is the fact that maybe it would rather bring in a little more transparency, at least for the government, is if they do add TDS to F&O trade. That is also something that we're getting to hear around, and whether the government could then also try and bring in an action where there will be this TDS cut on your F&O trade, and how that could really go on to impact the markets as well, and whether that would really change much even for your high frequency traders. That would bring in transparency at least, right?
No, well, for the large investors it doesn't. These are just procedures. There's one more procedure that they will have to contend with, but that's okay. If it's a smaller investor, for instance, if you're saying that, okay, if you start deducting tax at source, probably it makes it more cumbersome and he may not trade. Again, that remains to be seen. I mean, that's again applicable only if you're making huge profits, which most of the retail investors don't any which ways make profit. I did read that report somewhere. It said that it would help them track the investors better, but all in the realm of speculation, and I don't think any of these will. It's hard to see how any of these rules could make a very big difference to the composition of the various categories of investors. The big concern clearly that regulators and policy makers have at this point is that there is too much retail participation. That is for sure. Now, if whether they will try to address that through the tax route, that is what is that remains to be seen. But that may not be the most efficient way. Probably the answer may lay elsewhere.
Right. Well, it will be quite interesting to see how this budget actually will go on to surprise us, or even surprise the Indian equity market, maybe positively or negatively. We'll have to wait and see. But if the finance minister does mention any of these terms like capital gains or security transaction tax or STT, then that is something that the market is expecting or would want the finance minister to be addressing in the upcoming budget. And if there are any news and inputs that you think that the market will want to hear in the budget, do let us know, and this could then sway the markets either higher or lower. Let us know in the comment section below, and we'll try to see how that is different from what we've addressed. Well, hope this was useful and informative for you from me as well as Santosh Nair. Well, it was a pleasure to bring you this little deep dive into what the markets are expecting from the upcoming budget. But for more such content, keep watching Money Control for all your budget related queries.